Hello, folks, and welcome to Trade School here at ReadySetCrypto. Today is Friday, the 6th of December, I believe. And my name is Doc Severson. So whether or not you're watching live here today, hello, how's everybody doing? Or if more than likely you're watching this on some type of replay or looking at the archive and diving into the archives and finding topics, welcome aboard as well, too. Of course, if you have any questions after the fact, please reach out to me. Support at ReadySetCrypto.com, or you can find us on the Discord page. So today we've got a little bit of a, let's jump over here to, let's see, there we go. I'm down here in the lower left. Today's trade school is, let's see, not featuring any live trades, but we're going to be talking about setting stops and targets while scalp trading. So scalp trading is using futures, which we have a lot of lately. And of course, a lot of you are starting to trade the Digitex over the Digitex interface, right? So you're not holding anything in overnight. This is not swing trading or anything like that. So you're generally using a leveraged instrument, and you're diving into the charts and you're looking to take just a little bit of scalp, your fair share on the intraday movement. And this can happen at any time. So the cool thing about this is that the markets are open 24/7. So you could actually work a day job and then come home and try to scalp during your window. So the first step that we have to do here is to determine the ADR, which is the average daily range, and the ISL. Man, we're starting to sound like the military here with all these acronyms, three-letter acronyms, right? So ISL is your initial stop loss, And of course, rule number one of risk management dictates, hey, Tyke, how you doing? Good to see you on her. Rule number one of risk management dictates that you have to identify your stop before you enter the position. You can't just sort of arbitrarily figure it out as you go along, even though that's kind of the natural thing. So determine the average daily range. So I just got to put a Google sheet together this morning, and we've got the dates, and I marked the highs, the lows, and then what I did was subtract the lows minus the highs. So highs minus the lows equals the range. And then what you're going to do is a very simple formula for this. And then what I'm calculating from this point is the average of the last 7 days. Now, is there anything magic about 7 days? Could you use 5 days or 3 days? Or yes, you can do anything that you want to. The longer that you make the average, the more it's going to smooth things out. 7 days seems to work pretty well. And what you'll notice in here is that, we get values all over the place. 459, 363. We get as low as 177. We get as high as 686. But the average here is about 380. And of course, you're going to have to do this almost every day if you want to stay in with that average. But sometimes what you'll do, and this is what I do on the NASDAQ futures, is I only do this once a week, because the NASDAQ futures don't change character all that often. Now, Bitcoin is a little bit different. Bitcoin can change from day to day to day. And so I would be more up on this. Using 7 days, I think, is fine, but I would be checking this every couple of days and setting up the new average for this. So this is what I start with. Now, is that the only way that you can do that? No, that's not the only way that you can do it. You can set up a stop basically on every trade that you do, but you're going to have to recalculate your position size based on that. So this is typically what I use is if I want to use a fixed position size that I know of, that I want to use kind of the same time every time, what I'll do is I'll set that initial stop loss, and then if I have to, I'll trim the position size down from there. So this means that your initial stop loss should be approximately, if we say that it was 378, we're going to divide that by 10. Just to keep the numbers easy here, let's make that about 40 points, which is actually pretty low. That's a pretty low stop in today's volatility. You can always make this just a little bit bigger, but of course, if you're going to do that, you have to change your position size to make sure that you're staying within the risk parameters. Hello, Lexus. Welcome aboard. So this is just the starting point for your stop loss. It should ideally not be more than that with the current volatility. And I shouldn't have to say this, but this is the way things work, right, in this business, is that somebody a year from now is going to say, hey, I tried using a stop of 40 points and it didn't work. I got stopped out immediately. Like, no, that was the volatility for December 6th of 2019, maybe not for some point going forward in 2020. So once we determine what our initial stop is, let's see whether or not it's going to work for your setup. Will it work for your setup? Does your setup allow for the stop to cause a reversal to get hit? Okay. So I just looked at a couple of here. Here's the short setup at 7,400. So what I'm looking at here is we have the hook. We have actually a lower high. So the 5X is starting to roll over at this point. We have a lower high setting up, another lower high. And now we actually get the hook, rising patterns, break to the downside. So we're starting to get an entry here at 7,400. So right there, right at that 7,400 level. That would put the stop, if we use the same stop as what we just talked about, that would set it up at about 7,440, which is going to be just above that level. Now that makes me sometimes a little bit nervous because, as we'll show later on in this session, a lot of times when you put a stop behind an obvious pivot like that, many times you can see one final little burst of volatility like that before it takes off. So be careful with that, but at least it is above and beyond that level, which is, I think, important. It's not a no man's land. So here's the problem that we run into with traders that are fairly new to this type of trading. It's very natural for you to wait until things feel a little bit better. So as the price starts to actually unfurl to the downside, now I feel better about entering the position, don't I? But now the problem is that if I put the same stop level here, then here's my stop. If I'm entering at 73.60, now my stop's at 7,400. It's not above really anything. It's in no man's land. So that's lousy placement of the stop. So I can choose to actually put it maybe up here or so, but now I'm going to have a 60-point stop. So if I'm going to use a 60-point stop, then I have to change my position size to make sure that I'm not taking on more risk than my account can allow. So just an aside, I am in the process of building the Trader's Edge class right now. I've got the first couple of modules out. I hope you guys have had a chance to start to dig into that. So you'll see me like every day or every other day or so, you'll see another module posted. We're going to do a big webinar next Wednesday, or I should say I'm going to do a big webinar next Wednesday, kind of like going into the reasons why this stuff is so important. So you guys are getting, your Omnia members are getting sort of a sneak peek at what's going on under the hood, and hopefully you're digesting this stuff. So one of the things that I bring up in the class that is a real problem for traders, especially ones that are a little bit capital constrained or not really, I guess, confident of their techniques, is this is very common. You're going to wait for things to feel good before you enter. You're going to wait too long before you enter. And so this is one of the very real things about scalp trading, is that you've got to get closer and closer and closer to what you consider to be the perfect entry. And it will never feel good. It never feels good to enter, because at this point, the overall trend is still to the upside. However, you're starting to see that, and probably the 25X is just now bending down and showing red candles. The Heiken Ashi is just now bending down and showing red candles. You're just getting the 5X RSI momentum to start to break down out of the overbought zone. And so the signals will more than likely be there for something like this. it's just not going to feel very good. And that's something you have to work through again and again and again. You got to get the better and better entries, because if you wait too long, you're going to be part of those that get chummed to death. So being decisive and not waiting for feel-good entries will pay over time. So here's another short setup. And this is very common for this, is to see the price, do this kind of thing in a bear flag, break down through the trend line, and just when everybody thinks that it's about to release, the price comes back up and retests that trend line from underneath. Irritating move. But again, you can't complain about what the price does. You only can learn to move along with it and to figure out what the price is looking to do. So the first one before the break, right? So this is the first one before the break. This is a lower high. I'm not necessarily sure if the 25X would be breaking over or not, but certainly the 5X by this point is showing a negative momentum. So this is a more aggressive entry to enter up here before the break. So again, right there would be your entry. Okay. And what you're going to find is if you get risk out on something like this, which we'll talk about in a minute, if you've got your stop set for break even, you're going to get stopped out on the remainder of your contracts. And then you just never know when these are going to occur, because if you look at this, this is the way that this one played out. This is the type of move. Let me tell you guys, you don't want to be in a choppy move like this that takes forever to move. I mean, look at this one. This one took hours to move. This one takes minutes. This is the sort of move that you want to keep looking for. And I'll put a big check mark for that. This is the sort of move. Now, how do you get a move like that? How do you get involved in a move like that? And this is the one thing I'm going to keep going over and over and over again, especially when it comes to the Trader's Edge class. You can't get a move like this if it's obvious, right? So let me go back to this one. The reason why, what people do is they say, oh, okay, so I want to go long, and maybe here's the first entry going long. That doesn't feel very good. Okay, so where's the next entry going long? It's right there. Okay, now where's the next entry going long? Well, it's right here. It's right there. Okay, so a lot of people whiff on this one. They whiff on this one because it doesn't feel right. And then they say, all right, the next one, I'm going to take the next one long. I'm ready now. I'm ready for this long. And so they take it long here, and maybe they get a couple of ticks to the upside. And then what happens is, of course, it just completely unfurls to the downside. This is your goal. This is your goal. This is your objective, is to figure out where the herd is going. The herd is looking for the easy entries. The herd is looking for the obvious entries that are late in the pattern. And you want to find a way to get on the opposite side of that, because the reason why the price moves like this is because you've got too many people leaning over the side of the boat. All right, too many people leaning on one side of the boat, and all of a sudden the wind shifts, and what's going to happen? The boom's going to knock them all overboard. And this is what you've got to do. You've got to find these moves where too many people are swinging in the wrong direction, and you want to be part of that. And it's not going to feel good at first. Entering short up here is going to feel like, wow, this is ridiculous. Well, here goes nothing. It's going to feel terrible. Lexus, do I prefer to take short or long entries with futures trading? I've gone back and forth over that. I tend to see longs a little bit better, just because, you know, if you look at what's been happening in the last 10.5 years in the equities markets, and therefore the futures markets, the index futures markets, it's been going up, right? So yeah, you can trade short, but more of the winning trades have been long, just because that's the way price moves. And what I found is that there's a different character between a short entry versus a long entry. Long entries tend to be more linear, they tend to set up slower, they tend to unfurl a little bit slower. Short entries usually occur when too many people are going too long and too late in the pattern, and they can be very quick like this. So yeah, that's a good question, because a lot of long entries don't take off like this. So there's an expression which is that price takes the stairs up and it takes the window down, and this is a good example of that. But these are not easy to find. These are not easy to find because your first instinct is going to be to try to get that aggressive entry. You may get a few ticks to that. You get stopped out on the runner, and then it takes off. So either you re-enter or you look for these back tests, and you look for areas. You look for these really mean trades where it's like you can see the price is out to get people. The price is not out to get people. It's not some institution. It's not some bad person doing something like this. It's people acting in their own self-interest, and usually against their own self-interest. That's what makes price move like this. There is an ADR indicator. So it's given a 7-day range of 334 for BTC USD today. I would compare it versus doing the actual calculation and see if it works out for you. If it's within a certain level of tolerance, normally the thing is like any indicator is going to have some level of smoothing action to it beyond maybe the 7-day that you're looking at. So I don't know why it would have a different value versus what I had looked at, so see if it works for you. If you can automate something like that, then knock yourself out. Okay, so now step 3. So the point here is that make sure that your stop is going to work for what you're looking for. Make sure that your stop is going to work for what you're looking for. So you could enter, these are both fine because that puts your stop well above there. And even this entry puts your stop well above this pattern. And that's the initial stop loss, right? That's the initial stop loss, not your stop loss after the price starts to unfurl. So what are your targets? What are your targets for what you want? Now, what I'll do and again, I trade mostly the equity index markets. What I'll do is I'll have fixed targets depending on the volatility. I'll try to get risk out, and then I'll try to run a contract as far as I can within a certain range. But I have to be smart about that. I can't be sitting there looking for a 40-point move if the market's only giving me a 10 to 15-point swing. So a lot of how you manage a position depends on how you split out your contract. So there's a couple of different schools of thought to this. I think that people, when they first start doing this, should use split up your contracts into 2. So I'm going to just label this RO and run. Let's say RU for runner. This is risk out and runner. So maybe what you're going to do is you're just going to look for a certain amount of value for this. And this should be about what your stop is. About what your stop is. And here's the runner, and the runner is going to stay within the context of the swing. So this will be essentially somewhere less than the ASL, which is the average swing length. And I'll show what that means in a minute. So risk out should be about, or maybe even a little bit less than your stop. And the idea is that half of your position is going to get taken off at that point. And then you've got a runner. And what you're going to do with a runner is, so maybe this is that's your initial entry point. So here's entry. And then here's going to be your ISL for this. Hope this diagram makes sense. Right? And so as the price moves in your direction, as soon as possible, you want to be setting up your remaining stop on the runner to break even. And then as the price continues to go, you're continuing to set that stop behind it at major pivots. Although be careful, because I mean, this is one of my own issues that I'm always dealing with. Is I always set the stop just a little too close, because you're always trying to find that balance of like, man, I don't want to give that all back. You know, maybe the price is gone, you know, a good 60 points or something like that, and then it's going to retrace a big chunk of that before it takes off again. And it's just, there's no easy way to do it unless you can automate that through a ladder interface that doesn't allow you to touch it. Okay, so let's get into that. So if you're running with a small position size, you're best off creating fixed targets. That will depend on the volatility, right? The average range and the swing length and things like that. So don't arbitrarily set this. Don't like, well, I had this one trade last year that, man, I ran that thing for 1,000 points. Okay. Well, maybe we're not getting 1,000-point volatility on a daily basis right now. We're not. So this is counter to all the advice that you'll hear. And I understand why people are saying this. The advice that you're going to hear is always set your reward to risk for greater than 1. And I believe that with all of my heart. But I'm telling you, if you're starting this, if you're relatively new at something like this, it's going to be extraordinarily difficult for you to do something like that. Now, why? Okay, so here's what I'm talking about. Let's say we're going to do a long entry. And let's say the price, here's our entry point. And here's our initial stop loss, which is down here. So I'll just say ISL. And let's say we're going to have, here is our target. That's our target. And let's say that we're not doing any kind of peeling off of contracts or anything like that. We're not splitting up the thing. What you will see, there's no doubt of this. What you will see is that, let's say we're taking a long entry. So here we go. The price is coming down to here. We're not entered yet. And then all of a sudden, bang, bang, here's our entry. We're long. Okay, we're long right now. Here's our target up here. Here's our stop. Okay, so the price is going to start to move up, and we're profitable, right? So we're like, yay. And then what's going to happen is it's going to slam down here to this level, and then it's going to take off again. And this pullback may even go deeper than your original entry. So here's my issue with this, is that I would rather that you learn how to get your fair share inside of here before you have to deal with all of this drama. Because it will happen and it will drive you nuts. And if you have a trade that you're up on and then you give back and maybe even get stopped out for a small loss, you are going to be so pissed off that you're going to get into revenge mode. I guarantee it. You'll get into revenge mode, and it's not a good thing. Been there before. It's not fun. It never works out. So I'm more concerned with you getting your fair share and learning how to profit from these trades. So there's nothing that you experience will create more frustration than seeing a profitable trade give back everything and more. Hate it. Hate it. So this is why it's good to be able to split up your position size. So just take a little bit off, move your stop up. So a lot of people like to trade in thirds. That's typically the recommendation that you'll hear from people. Don't start with thirds. Start with, after you learn to manage a very small position and start to look for the setups. Then maybe as you grow your position size a little bit, split it into 2 and learn how to trade on 2 chunks, right? And then you can always move into 3. So risk out target should be set at or less than your stop value. Just so you have it, you don't want to set up a target that's going to require you to sit there and sweat it out for hours, right? You want to just catch that simple move, take your risk off, and then put your trade into position where you can literally walk away from it. And this is what's going to be so great when we can get actual OCO bracket orders for like the ladder interface for Digitex. So Arshad is saying, I have been there. It might also run straight up, but I would rather book maybe 75% of the profits. Yeah. Pick a level. Don't be afraid to, what you don't want to do is get so scared that you're eating like a bird and crapping like an elephant. Like if your stop is that much bigger than your profit target, then yeah. So don't take it to the extreme. Like don't just take a couple of ticks off there and they're like, okay, I won that trade, because eventually you'll give it all back and more. So there, at some level, you have to earn the right to gain the courage to stay in a position like that. Okay. Next, what is your average swing length? What is your average swing length? Some of you may have heard of this before, many of you have not. So these can typically be seen on the 5X chart. So if I'm trading off of a 12-minute 1X, I'll use the 1 hour chart as my 5X, and this is where the swings pop out much better. So in a case like this, this is some recent price action here. This move is, I don't know if you call this 1100 or whether this is two 550 point moves, but there's 1100, 400 up, 800 down, 800 back up, 500, 800. Right? So if you're sitting there trying to run this thing for 2,000 points, you're going to have a very difficult time to do that. You've turned it into a swing trade. And that's not the intent for scalping. The intent for scalping is to get in, get out, have a life, get your fair share, spend more time not trading than trading itself. That's the point. You want to look for these areas where the herd gets it wrong. I can't underscore that enough. The better that you can understand herd psychology, which is important and is what I'm going to be talking about through this edge class that I'm building right now, is understanding how to read a crowd and understanding when they're likely to be wrong. When they're likely to be wrong, that's when you want to be on the other side of them. So you can look at a 1X or a 5X chart here, a 1 hour chart, and you understand kind of the swing lengths. What's the potential here? So right now there's, it's somewhere, I would say if you're setting up for a swing of maybe 500 points, that's probably okay. That's probably okay. Now notice how many hours it takes for one of these swings to unfurl. In some case, each one of these candles is 1 hour. So don't forget that. These are significant trades. These are significant swings here. In some cases, it's taken a long time. It's taken a couple of days to move that 500 points. In some cases, it's taken 1, 2, 3, 4, 5, 6, 7 hours to move 800 points. But are you going to sit in front and manage that trade for 7 hours? It's unlikely you want to do that. I try to limit the activity that I spend to an hour a day. More than that, and you're just digging your way out of a hole, and it usually doesn't work that well. So understand the context of what you're trading within, especially if you're going to run something. So maybe your risk out is going to be, your initial risk out is going to be close to that stop. It's going to be maybe 1/10 of one of these swings. So how much you can harvest out of a swing depends on the average swing length. It depends on your time. It depends on your tolerance for risk. What you're going to have to do is, if you truly want to swing something, right, what you'll see is that you'll get these, you get these price swings, which are going to do things like this. They're going to pull back really hard on you. And if you really want to squeeze everything out of that, you're going to have to set up something where it's going to be based on some type of volatility envelope, like the Keltner channels, maybe even the Bollinger Bands, and maybe even a moving average. So in some cases, a moving average will provide a good level to hide a stop behind during that swing. But this is really for these longer, check back in 6 hours and move your stop up kind of thing. And again, I'm kind of excited because there are a lot of very good ladder interfaces out there for trading futures that can automate all of this for you. So once you're in, you can literally walk away from a trade and you're done. It's either going to work out for you, but it's going to manage all the elements of the trade management, which I think is great. So we're not there yet with crypto though. But one of the things that I'm hoping is that once you learn things like this, you can apply them to all different types of markets, whether it's Forex, whether it's index futures, whether it's cryptocurrency, what have you, because it's all essentially the same thing. When I look at a price chart, I just see a price chart. I don't see the project, right? So the fundamentalists, guys like Mav, guys like Checkmate, are typically looking at the fundamental value and proposition for something. And that's great. I look at the price. The price is the price. I look at a price of Bitcoin as being essentially the same thing as the 10-year bond, as being essentially the same thing as the NASDAQ. It doesn't matter to me. They all pretty much run the same way because it's all based on crowd behavior. All right, let's see. So having multiple contracts that you can peel off allows you to book profits, eliminate risk while staying in the larger 5x swing. This is a more advanced skill because if you pile on the contracts, you're going to have that level of risk. So keep things really super small to begin with until you really build your system. Keep it really super small, like ridiculously small. Like, why am I even doing this kind of small? Because only when you do that, or should I say, only when you don't sense any danger. And this goes to your subconscious mind. When your subconscious mind does not sense any danger, then it's able to effectively and functionally manage the trade. As soon as it senses danger, then it goes into dinosaur brain mode. And this is why we do the stupid things that we do, because it's been programmed that way. And so it's almost a lifetime of trying to unprogram your brain like that to be able to accept risk and say, hey, this is good for you. You just don't know it yet. So step 4, avoiding the obvious. Let's see, a question here from Lexus. Do I use the CHOP index exhaustion as well to exit the trade? Not to exit the trade. Okay, so what I'll do is if I get my meat hooks into a runner, what you'll see is that, so let's say I've got a swing. I went long on this swing and I've got risk out, check. So I've got my meat hooks into a runner and it's working well for me. And I know I'm going to profit on this trade. Okay. What happens is, let's see, let's go with a different color here. What will happen is that swing will cause the CHOP index to go plummet into exhaustion. So what do I anticipate there? I anticipate range expansion will move to range contraction. So I'm going to anticipate that the price is going to choppity chop, 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 you know, and maybe start taking out some pivots down there until such time that we have it charged again. And then, so I'm trying to raise my stop to not get it too close just yet. And then as it starts to break from that type of, you know, then I'll sneak the stop in under here, not too close, because a lot of times you'll see wham, like that. Oh, does that piss me off when that happens? And that's just human nature. There's no way you can predict something like that. But I will wait until, to your question, I will wait until the CHOP index builds back up again, and then I'll be more aggressive with the stop, because if that swing is going to release again, that's the time when it's going to take off, which is usually, this is the second entry into a trend, into a 5x swing. That's the second entry. And if this thing sets up with a lower high and a lower low, then it's done. And maybe that's all I'm going to get out of it. But that's the thing, is learning to be patient with your runners and not slam the stop right up against there. And, you know, because that's where you get your bigger gains. And that's always what you want to be doing, is your risk reward, you want to be working on getting that risk reward into, squeezing all the blood out of that swing that you can. So to your question, I don't use it for an exit, but I will use it to understand the context of how I should manage the position. And it comes very naturally after a while. There are many different traps to avoid when you're doing this. And if you haven't done any trading like this, you'll find them, because it's like, wait, what? How? That's some of the reactions that you'll get. Like, how did they, those bastards, So here's a good example. It looks like it's set up for the next swing down, right? So what do we have here? We have, plenty of, this is all down, down, down. And more than likely, the 25X is showing all red candles on the Heiken Ashi, and there's every reason to believe that this should go on. But did you notice that the price actually made a higher high first? So if this is the high, here's a higher high, and that's a clue. And more than likely also the 25X is probably an exhaustion. So this typically all happens at the same thing. You start to get price clues, you start to see exhaustion on an anchor swing, but maybe you missed out on this entry and this entry and this entry and this entry and maybe even this entry too. And you're like, oh man, I want to get one of these swings. This one feels really good. So maybe you go short on this swing as it starts to release to the downside because it feels good. And then what happens is you get slammed in your face on this bugger. So it's very easy to get complacent on this. So one of the things that I bring up in the Trader's Edge course is that you have to understand yourself. You have to avoid those setups that feel good. Because if a setup really feels that good, more than likely it's going to slam right back up in your face. You're about to get faded. Because it feels good, right? It's like, okay, I've got confirmation of the downtrend. If you got confirmation of the downtrend, you're too late, right? You got to get in early on these things. So here was the entry, and it got poof, right back up in your face. This is what I call a trap entry. Notice that this is a higher low on the 5X chart and the beginning of the reversal. But here is the first clue. This went up to a higher high. Here's your higher low. Now you got a change in polarity back up to an uptrend. You got played. You've got played. You should also expect to see every obvious pivot retested. I actually had a Omnia member reach out to me a couple of days ago and said, hey, could you look at this setup here? What the hell did I do wrong? And nothing really wrong, but it's, man, the pivot was so obvious that it did get retested and slightly undercut. And it'll make you furious when that happens. So here's, same chart, here's the long entry. So now that we're in a 5X uptrend, more than likely the 25X now is shifted to green Heiken Ashi candles. So we're good to go. We got a nice entry here. We got plenty of energy on the 5X. And it looks like, boom, here's an entry. So there's a long entry. And again, we're looking at the 60-minute chart. We're not looking at the true 1X signal chart. But bear with me here. So we have, we got a long entry. Let's just put it that way. So obviously you want to put your stop loss right below there, just above 7,400. Well, the problem is here was that entry and it came up a little bit to a lower high and that slammed back down, took you out, and then it took off. And you will learn new words to say when these things happen to you. You'll get a whole different vocabulary that occurs when things like this happen. So it's like, there's your long and it's starting to work. And then, boom, took your stop out. So I'm saying here, hopefully, I mean, this is a big enough swing that if you got involved here at 7,500, man, there's 100 points of meat on that bone. Hopefully you've got some profits out of this and you've got your stop backed up to break even by that point for the runner. you've already booked a profit on risk out contracts, and you can decide whether or not you want to re-enter on this swing. There's the next entry on the swing, more than likely, with the 1x right there. It happens. It happens. So just be prepared for this sort of stuff, because markets that can be pushed around will be pushed around, because when people put stops under obvious places like this, there's stop hunting runs. And it looked like this one happened, you know, it wasn't some odd time of day, at least in the US. Okay, so that was my material for today. I could probably go on hours and hours about this stuff. It's, you know, people get attracted to this style of trading because you see the price moving around all the time, and hey, man, you know, can't I just hop a ride on that thing? But there's a lot that goes into it, and there's a lot of experience that you have to bring to it, and rock solid discipline, and it can be a very emotional experience if you're not used to it, especially if your risk is above your radar. It'll drive you crazy. So any questions before we take off for the weekend? Don't forget to check out the new class. I've got the first couple of modules up, and I should be getting at least every day or every other day or so, like another module up there, and we'll have a big kickoff next Wednesday. But you guys are already going to have, obviously, the first look at this. So over the weekend, I should have another 1 or 2 modules up there, and this is my favorite stuff to teach. Just the whole mindset thing, and how to not only trade against yourself, but understand how you process risk. Understand what works for you, because quite honestly, if you can't do that, if you can't start thinking differently about risk, then you're going to be on the same trajectory as everybody else. There's a reason why only a small percentage of traders really make it in this market. And you can learn all the techniques, all the strategies. You can sit there at parties and quote chapter and verse about how unbalanced volume is the best indicator, or what a negative divergence is. You know, there's plenty of people that are out there that are really smart with trading, but as soon as they've got a live position that's got live risk that represents a threat to them, their subconscious mind just turns haywire. And so I got a request here to look at the BTC chart. We can do that. Let's bring that over here. So you're going to have to do this at one type or another. You're going to have to do this. All right, so what do we have here? Let's go from the top down. We have a weekly downtrend. We've got a little bit of positive momentum here in a weekly downtrend. But more than likely, the only thing that's going to occur from that is just going to be, if this decides to go up here, it's just going to be a revisit to the top of the range, or the top of that channel, until such time that happens. So is this moving higher? Well, I don't know yet. So far, we have a lower high. The momentum for this is still to the downside. So the highest probability at this point here is that we set up a lower high and roll over again and maybe revisit 6,500 again. That's the highest probability. That doesn't mean that that's going to happen. The other possibility for this is that we break above 7,500 on some kind of good news, and then form a higher high, and then start to press against this upper range. And this is why I box in the price action. And right now, the box for that is, I would say, approximately 7,750 down here to maybe 7,100. So it's about a 600-point range. So right now, this is what you're trading inside of. It's about a 600-point range. Let's see, Tig, is there any way to calculate what percent of a drawdown you should accept on a particular chart before stopping out? Just below previous high or low? Well, I would say a lot of that, Tig, depends on, really the answer to that quite honestly, is to trade such small positions that they don't even reflect it. They're not even on the radar. So these days, I mean, if you're trading something like a BitMEX, to get a full size position that's fully leveraged, let's forget about the leverage slider. But if you were to trade 7,500 contracts, at every point that BTC goes higher, your position would gain or lose $1. So 1-to-1 leverage. So I'm talking about maybe trading something where you're only trading maybe 10 contracts or something like that, just something really super small. So there's ways to create, like with fixed ratio, earning the right to trade bigger. So you set up these levels that if you say, okay, I'm going to start trading with 10 contracts. And if I'm able to grow the capital by X amount, then I'm going to go up to 20 contracts. I'm going to double my position size. And then if I can build it up to that point, then I'm going to go up to 40 contracts. And it's kind of like the same thing as like if somebody were to give you a penny on the first day and then double that every day. You know, would you take that? Would you take that compensation package? And you surely would if you looked at the 30-day package of that. Because by the end of it, you'd be a millionaire. So that's kind of what you do with something like this, is start really super small below your radar and then find out where your radar horizon is, because at some point you're going to reach a point where it's like, ooh, okay, I'm a little scared about this. This is like, you know, now you're up to 15,000 contracts and it's like, okay. And then this is where you start operating differently, and you have to find that level and stay below it. So there's all kinds of different ways that you can mechanically set up your position size for this. So again, we're stuck in a box here. I don't know which way this is going to go. And it's not for me to say which way it's going to go. It's for me to let the price do what it's going to do. But I know that if the price breaks above 77.50, that especially on decent volume, if we get decent volume on that, then that increases the chances of it going up to maybe as high as 8,500. But I would say it's going to be a tall task to break this thing out until we get some big time volume. And the best way to get big time volume is to really have the price go down first. This is what leads to these big flushes to the upside. Okay, any other questions? Anything else going on? Make sure you get a chance to start in with that new course. So the Your Trading Edge course, it's in the catalog now. All right, let's see if anything else is moving here, just while you guys are. Yeah, Decred is, yeah, I don't know why this one is. Actually, Checkmate sent me a note the other day. I don't know if Decred is on any other broker. DCR. Let's look at this versus Bitcoin, and that's a little bit better. There we go. So Decred is actually, if we look at this, let's look at the weekly chart. We're starting to get a nice weekly swing now to the upside. However, this is, until it proves itself, this is just another lower high. But if this is able to break higher, put in a significant higher low, and then beat that high, this is where we want to be very, very aggressive about getting on. So a 13% rally in one day is pretty good. We have Zilliqa has been actually pretty strong lately, although you'd never know it from looking at the weekly chart. So not too bad, not too bad there. Let's see if anything else is moving. Oh, let's see. Digitex was moving before, and it has come back down to earth. I think the market has said, oh, that's all it's doing. So even though they've actually taken a pretty big step of getting what appears to be a working platform, they got to make sure it's stable. So they're doing the right thing. They're doing the right thing. And that's pretty much all that's moving around today. All right, folks, thanks for hanging out with me in today's Trade School. Today, December 6th, 2019. Thanks for your questions, and we will see you later. You guys have a great weekend. Take care now.